Brad Williams, Frugal Finance, bonds, understanding bond yields and return. There's no ifs, ands, or buts. There are a lot of moving parts in fixed income securities. I'll just touch briefly on coupon yield and current yield. What's the difference? Investing in bonds, you want to know about yield and return. Yield is a general term that relates to the return on the capital you invest in a bond. Price and yield are inversely related. As the price of a bond goes up, its yield goes down and vice versa. There are several definitions that are important to understand when talking about yields as it relates to bonds: coupon yield, current yield, yield to maturity, yield to call, and yield to worst. Let's start with the basic yield concept. Coupon yield, also known as the coupon rate, is the annual interest rate established when the bond is issued that does not change during the lifespan of the bond. Current yield is the bond's coupon yield divided by its current market price. If the current market price changes, the current yield will also change. For example, if you buy a $1,000 bond at par, often described as trading at 100, meaning 100% of its face value, and receive $45 in annual interest payments, your coupon yield is 4.5%. If the price goes up and the bond subsequently trades at 103, 1,030, then the current yield will fall to 4.37%. Current yield matters if you plan to sell your bond before maturity, but if you buy a new bond at par and hold it to maturity, your current yield, when the bond matures, will be the same as the coupon yield. Coupon and current yield only take you so far down the path of estimating your return your bond will deliver. For one, they don't measure the value of reinvested interest. They also aren't much help if your bond is called early, or if you want to evaluate the lowest yield you can receive from the bond. In these cases, you need to do some more advanced yield calculation. The following yields are worth knowing, and you can find them using FINRA's fixed income data. Yield to maturity is the overall interest rate earned by an investor who buys a bond at the market price and holds it until maturity. Mathematically, it is the discount rate at which the sum of all future cash flows from coupons and principal repayment equals the price of the bond. Yield to maturity is often quoted in terms of an annual rate and may differ from the bond's coupon rate. It assumes that coupon and principal payments are made on time. It does not require dividends to be reinvested, but computations of yield to maturity generally make that assumption. Further, it does not consider taxes paid by the investor or brokerage costs associated with the purchase. Yield to call, which is figured the same way as yield to maturity, except instead of plugging in the number of months until a bond matures, you use a call date and the bond's call price. This calculation takes into account the impact of bond yields if it is called prior to maturity and should be performed using first date on which the issuer could call the bond. Yield to worst is whichever of a bond's yield to maturity or yield to call is lower. If you want to know the most conservative potential return a bond can give you, you should know it for each callable security. Then perform this comparison. Interest rates regularly fluctuate, making each reinvestment at the same rate virtually impossible. Thus, yield to maturity and yield to call are estimates only and should be treated as such. While helpful, it's important to realize that yield to maturity and yield to call may not be the same as a bond's total return. Such a figure only accurately computed when you sell a bond or when it matures. Figuring bond return: if you held a bond over a long period of time, you might want to calculate its annual percentage return, or the percent return divided by the number of years you've held the investment. For instance, a $1,000 bond held over 3 years with a $145 return has a 14.5% return, but a 4.8% annual return. When you calculate your return, you should count for annual inflation. Calculating your rate of return, as it is often referred to, will give you an idea of the buying power of your earnings in a given year. You can determine real return by subtracting the inflation rate from your percent return. As an example, an investment with a 5% return during a year of 3% inflation is usually said to have a real rate of return of 2%. To figure total return, start with the value of the bond at maturity, or when you sold it, and add all of your coupon earnings and compound interest. Subtract from this figure any taxes and any fees or commissions. Then subtract from this amount your original investment amount. This gives you the total amount of your total gain or loss on your bond investment. To figure the return as a percentage, divide that number by the beginning value of your investment and multiply by 100. Here's an example that provides your total return. End value of principal plus coupon interest plus compound interest minus taxes plus fees and commissions minus beginning value of principal, and divide that by beginning value of principal. Multiply that times 100. Reading a yield curve? You've probably seen financial commentators talk about the Treasury yield curve when discussing bonds and interest rates. It's a handy tool because it provides, in one simple graph, the key Treasury bond data points for a given trading day when interest rates running up the vertical axis and maturities running along the horizontal axis. The typical yield curve is upward sloping, meaning that securities with longer holding periods carry higher yields. In the yield curve above, interest rates and also the yield increase as the maturity or holding period increases. Yield on a 30-day Treasury bill is 2.5%, compared to 4.8% for a 20-year Treasury bond, but not by much. When an upward sloping yield curve is relatively flat, it means the difference between an investor's return from a short-term bond and the return from a long-term bond is minimal. In such a situation, investors would want to weigh the risk of holding a bond for a long period versus the only moderately higher interest rate increase they would receive compared to a short-term bond. A real-world application of the Treasury yield curve is that it serves as the benchmark for the vast majority of mortgage rates. Mortgage interest rates typically follow the yield of the 10-year U.S. Treasury very closely. In fact, they have moved in tandem for more than 30 years. The Department of Treasury provides daily yield curve rates, which can be used to plot the yield curve for that day. Comment if you have any questions related to bond yields and returns. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.